Hello everyone, I hope all of you are doing great today and you must be enjoying your weekend. So my name is Ahmed and I am your tutor for the AA Practice to Pass webinars exclusively by ACCA. Okay, so happy weekend in advance, and I hate working on weekends, so ACCA have decided to come up with Saturday, Sunday, Monday and Tuesday. But hopefully all this effort will ensure one thing, and that is that Monday 5th September 2022 will be a winning day for all of us. Let's make it a winning day for all of us. And yes, we can ensure that, and we can make it happen by just making things a lot more simple as they rather than making them complicated. So on your screen right now is my cell number, and I am available on WhatsApp. So you can contact me for any other queries. Apart from that, this is a 4-day webinar, and we will be covering pretty much everything from the AA study guide. Okay, now what? So just a brief introduction about me. I am currently part of 2 learning providers. I am proudly representing School of Business and Management, Islamabad, which is an ALP, a platinum based ALP situated in Islamabad, that is in Pakistan. Moreover, I'm also teaching at WIFI, which is a gold online ALP. Apart from that, I do teach to CIMA and CMA students. My core subjects are basically, there are 2 domains of me. Number 1, the management accounting leading to the performance management, and obviously lastly but surely not the least, the AA and the AAA. So this time ACCA has allocated AA to me. The last cycle or the session of webinars, that was June 2022. For the attempt June 2022, I did the webinars for the ACCA regarding the AAA. Okay, so now what? Let's straight away go to the exam format, and let's try to help those who are a bit behind, who are feeling confused, or who are somehow somewhere in the land of confusion. So yes, we have got a decent time at our disposal and we can make it happen. So the exam format of the AA is relatively a challenging one if you're going to compare it with FM exam, PM exam, FR or tax exam. So when it comes to skill exams, the most challenging exam format is definitely the AA exam format. Why I'm saying that? Because when it comes to AA, there will be 2 sections only rather than 3 sections. In the first section, that is the section A, there will be 3 OT cases. In each and every OT question, you'll have 5 questions per OT, and 5 2s are 10, 5 2s are 10, and another 5 2s are 10. So that gives you 30% of your total marks. So there will be 3 MTQs or OTQs. Each and every one will have 5 questions each. So 5 2s are 10, 5 2s are 10, 5 2s are 10. That makes it 30 marks for the section A. Now what about section B? Section B will have 3 long questions. The first long question will be for 30 marks. The second and third long question will be for 20 marks each, and definitely the section B will be further divided or classified or subcategorized into different requirements such as part A, B, C and D and so on. So this is the exam format. It looks challenging, it is challenging, but you can make it happen by working smartly, which I will be guiding you towards the next 4 days, including this one. Okay, now I need to make you understand what that exam format looks like and what you should expect in the section A or what you should expect in the section B. But before that, we need to understand that there are overall 7 areas in the AA course content according to the ACCA's study guide. Now those 7 areas are divided into two parts or two types by the AA examiner. The first is called the major areas. The second one is called the minor areas. Why it is important to distinguish between major areas and minor areas? A, because of the fact that major areas make up the greater proportion of the final exam. B, we need to understand that if we are going to totally ignore the minor areas, we cannot and we will not pass on Monday, 5th September. Mind you, you have to pass or fail this exam on 5th September, not on the result day. There are two types of students. A, who are going to attempt the exam and now they will pray and they will hope and their fingers will be crossed forever. B, yes, we'll pray, yes, we'll be optimistic, but we will attempt the paper in such a way that we will feel confident after, once we are done with the exam. We'll feel confident after the 1 week of the exam, when we are going to take up the next paper, the next challenge, the road to the success, the next ACCA exam. So we have to make sure we are not just attempting the paper, we have to make sure we are securing this AA exam. And yes, we can secure this exam in the upcoming days. So even if your preparation is nowhere, even if you know glimpse of AA, you know something about audit risk, you're not that sure when it comes to controls, you're not confident when it comes to the most painful topic called substantive procedure, or for that matter, if your minor topics such as ethics, corporate governance and internal audit is not under your command, we have got time to catch up, and we have got time and a technique and the experience to deliver and to make it happen. Okay, now those 7 topics, as I just discussed earlier, could be divided into 2 categories: the major area or the major areas and the minor areas. So here is the course content for you. The first topic is what we call ethics and acceptance. The second topic is called audit risk, which is a major area. The third topic is called internal control system, another major area. The fourth topic is called substantive testing or substantive procedures, another major area. The fifth, sixth, and seventh are the minor topics: the corporate governance, internal audit, last but surely not the least, review and reporting. Now, those 7 topics would be covered within the next 12 to 13 hours we have. So we have got 4 days. We have got 4 days for this series of webinars. We have got 3 hours per day approximately. So approximately 10 to 12 hours, and 10 to 12 hours are good enough for me to make you understand every important aspect of this course content. So trust me on that. I'll be covering each and everything, and I'm not going to skip anything. I'll try my best to cover all major areas and even the minor topics. Okay, exam format all over again. Why is that? Because now I want to make you understand which topic you should expect in section A, which topic you are going to experience in section B. So as far as the section A is concerned, according to the examiner, according to the past papers, according to the reports, and according to the trainings what I have experienced over the period of last 10 or 12 years, any area of the AA study guide can be and will be tested. So when it comes to section A, anything could be tested. But in general, or in generally speaking, out of 30 marks, at least 20 marks are allocated by the examiner for the minor areas such as ethics, corporate governance, and so on. But you got to understand that anything could be tested when it comes to section A. Okay, what about section B? In the section B, there will be 3 long questions, and the long questions will focus on the major areas. So those 3 long questions will focus on the 3 major areas: the risk, controls, and the substantive procedures. But having said that, within the section B, out of 70 marks, approximately 20 marks will be allocated by the examiner for the minor areas. So if you have got common sense, which you definitely have, otherwise you won't be sitting right now in front of your laptop watching this. So 20 marks within the section A are relevant to the minor areas. Approximately 20 to 25 marks within the section B are relevant to the minor areas. So guess what? Are you going to prepare minor areas, or are you going to be one of the, one of them? One of the most common characteristic of failure student is they are never well prepared for the minor areas. So I hope you understand that we have to allocate good enough time to the minor areas as well, along with the major topics. Is this clear? Okay, now comes the bad news. The global pass rates of AA, starting from June 21, very pathetic 39%. September 21, very pathetic 39%. December 21, the winters were not pleasant enough, 38%. Then March 2022, so 2022, kind of a post-COVID times, things got better, 44%. That's more like it. But guess what? It did not last longer. And the last attempt, June 2022, was again, it had a huge dip to 39%. Is this a pleasant picture in front of you? Is this a pleasant situation? Give me a second. Okay, is this a pleasant picture? No, this is not a pleasant picture. I need 2-3 minutes on that. I need to wake you up. I need to make sure that the next 10 hours, the next 10 or 12 hours between us should be very productive, and those 10 to 12 hours, especially the next 5 to 10 minutes, should be an eye opener for you. So I don't want to scare you. I just want you to realize things, and I do have a plan to counter this pathetic result. Okay, now as you can see, 39, 39, 38, 44, 39, overall the average could be 40%, right? Now you got to compare this 40% of AA with the FR exam. It's 50% approximately, the average. If you're going to compare it with tax exam, it's 50, 48, 49, 50% approximately. If you're going to compare it with FM, it's going to be 49, 48, or sometimes 50%. If you're going to even compare it with PM, yes, the PM will be somewhere around AA, 42, 43%. Now you have to understand why the pass rates of AA are so pathetic. They are so pathetic because of many reasons, and let me tell you those reasons why students all over the world, all over the globe, fail this exam so much. Why the failure rate is on a very, very higher side. Okay, the failure rate is on the very, very high side. But before I move on to that, I would like to highlight that in our part of the world, in subcontinent, or for that matter, in my country, Pakistan, the failure rate of AA is much, much, much more pathetic. Why is that? Because English is not our first language, so that creates an added hurdle, an extra problem for us. So when it comes to FR or tax exam, the results in Pakistan or in our part of the world, they beat the global rates. But when it comes to AA exam or AAA exam, the results produced by the, by this part of the world is well below, it's well below as compared to the uh, global pass rates. Now what? Why students fail this AA exam? There's a slight error over here. Why students fail in AAA? It's why students fail in AA. Okay, why students fail in AA? The top of the line reason is majority of the students who are going to attempt on Monday 5th September 2022, they won't type the questions on the ACCA practice platform. So this is the problem, and that problem leads to failure. Now if you want to counter it, because I promise you I will be telling you the solution against each and every problem. So the students are failing this exam because they are not working on the ACCA practice platform. What option do you have? Today is what, 20th August, right? So you have got a decent 15 to 16 day period. So you have got at least 2 weeks, right? What you can do is start working on the ACCA's practice platform, the blank workspace, solve the past papers on the ACCA practice platform. Do nothing but the ACCA's practice platform. You're not supposed to solve any question anyway. Do not use Microsoft Word. Use the ACCA practice platform. In fact, I would like to add one more thing. When you go for your exam, the examination hall, the British Council provide you with a keyboard, right? They don't provide you with a decent, sweet and soft laptop, right? So you should use an external keyboard, attach it with your laptop if you're using one, and work on your keyboard. Work on ACCA practice platform with the help of a keyboard externally attached. So this is the first problem, and I've told you the solution as well. Now, why students fail this double exam so much? The second reason, the students do not prepare the OTQs from both exam kits. They end up scoring 12, max 14 marks in the section A. Even if you're going to score 16, you're not going to pass this exam. It becomes a lot more challenging for you. So what option do you have? You have got 15 days. You have got overall 65 to 70 OTQs in both kits. So if you're going to solve 6 OTQs per day with a window of 3 OTQs in the morning, 3 OTQs in the evening, so you still can solve all the OTQs from both kits. Do not check out the solution in the first go. Once you are done with the 3 OTQs, have a break and then check out the solution. Even if your answers are correct, do read the solution, try to understand which option is correct, try to understand which option is not correct and why. So you can make a plan for yourself after today's session. 3 OTQs early in the morning, 3 OTQs maybe in the evening. So 6 OTQs per day, and you have got 15 days in your final exam. So you will be able to solve a handsome number of OTQs, and I'm sure, I'm 100% sure you will be able to finish off both kits, the Kaplan and the BPP. Okay, reason number third. In the section B, there will be approximately 10 to 15 marks allocated by the examiner, which we call straightforward bookish knowledge based questions. The examiner will come up with certain definitions such as define audit risk and explain the components of audit risk. What are 5 fundamental principles of ACCA's code of ethics and conduct? Or maybe define the 5 threats associated with the objectivity of the auditor and give one example for each one. What factors you need to consider before accepting or continuing, before accepting a new audit client or continuing with an existing one. What are the contents of the engagement letter? Or maybe what are the components of the internal control system? How do you define CAM? How do you define MURGC, that is material uncertainty related to going concern? So all those stuff. What are the advantages and disadvantages of outsourcing an internal audit department? So all that stuff is what we call straightforward bookish knowledge question. You are not supposed to come up with your own wording. You have to heavily rely on the book. You should come up with the bookish wording in order to maximize your marks. So this is what we call straightforward bookish knowledge based questions. You can invest half an hour daily starting from tonight on the straightforward bookish knowledge question. Moreover, whenever you are attempting a past paper or an exam kit question, do not ignore or do not underestimate the importance of such questions within a past paper question. So that's the third reason of failure. Many students will fail at 47, 48, 49, and they will end up attempting just the 90 or 88 mark paper. When you are going to ask them why you did not attempt the full paper, maybe because of the typing speed, maybe because of the fact that they were not familiar with the ACCA's practice platform. But there is also a huge possibility that they would come up with an explanation. Yeah, I did not attempt more than 90 marks because there were 10 marks available in the question, which I had no clue whatsoever. Oh, well, what was that? Those were definitions. Those were straightforward bookish knowledge questions. So don't fall in this trap. The second last reason why students fail this exam so much, there is a very technical exam technique when it comes to the three major areas such as risk, controls, and procedures. But you don't have to worry about it because I will be teaching the exam techniques with respect to these three major areas on the day 1, on the day 2, and on the day 3. The day 4 will be completely dedicated and allocated to all the minor areas of the syllabus. Okay, what about the fifth reason? The fifth reason is do not ignore the minor topics. Do solve a question on ethics. Do solve a question on corporate governance. Do solve a question on internal audit. So you can expect and you should expect a certain requirement within the section B from the minor areas. So last but surely not the least, I think one of the most important reason by a greater margin, comprehensively the most important reason is the failure students never attempt mock exams. You have to attempt at least 3 mock exams in a stretch, like in the exam conditions. You have to attempt at least 3 mock exams under strict exam conditions, and at least one of that mock exam should be marked by any AA expert tutor. So if you are going to attempt 3 mock exams, if you are going to get feedback by an expert tutor, I think you will straight away jump from 40 to 60, 50 to 50, 65. So this mock exam and the feedback would give you a nice and comfortable jump of 15 or maybe 20, bare minimum 10 marks jump in your final script. Is this clear to everyone? Why students fail so much? Okay, now here comes my plan. My plan is that I will be covering audit risk tonight. I'll go to the internal control systems tomorrow. Then the day 3 will be on the backbone of this course, which we call substantive procedures. Last but surely not the least, the day 4 would be about the minor topics, and those minor topics are number 1, ethics, number 2, corporate governance, number 3, internal audit, last but surely not the least, the audit report along with the completion and review. So this is what my plan looks like, and you can see the day 1 would cover approximately 20 or maybe 25 marks of your final exam. The day 2 would cover approximately 20 or 20 to 25 marks of your final exam. The day 3 would be about substantive procedures, which is about 25 to 30% of our final exam. Last but surely not the least, the minor topics would at least cover 30 or maybe 40% of your final exam. So I would highly encourage all of you to attend the day 4 if you want to be a safe student, a happy student, a student that is targeting 5th September 2022 as a winning day. Okay, before I move on, if there is any question from your side, I would be happy to answer that. Sonika is saying no voice. Okay. Is there any WhatsApp group? Yes, there is a WhatsApp group, and the link will be provided to you by the ACCA team. Otherwise, apart from that, you can contact me and I can share the link of the WhatsApp group as well. Okay. Yeah, Omar, definitely not. Where I can see the recordings, if I've missed anything, well, ACCA YouTube channel. Okay, double in Kaplan is okay. Washington is asking for the AA Kaplan latest kit. When you are going to join the WhatsApp group, you got to check the description of the WhatsApp group and you will get everything relevant to the webinar, everything relevant to the AA within that WhatsApp group. Okay, how to contact me? Okay, that's a valid question. So on your screen right now is my number. I am available on WhatsApp and you will okay, so this is it. This is how you are going to proceed. Now what? So should we start the first topic? The first topic of this webinar series? Okay, guys, you are having a problem. You are unable to copy the WhatsApp group link, right, from the answer section. No problem with that. You can contact me on my personal number and I will share the WhatsApp group link to you. And within that WhatsApp group, you got to check the description of the group. And within the description, you will be able to figure out notes, the exam kit, the book, and the questions which we are dealing right now, or which we are going to deal tonight, those as well. Is this clear? Oh, sir, are there any changes in the syllabus for this year? No, there is no major change. Yes, Zora, I will share the BPP kit within the group as well. Don't worry, but after the obviously tonight's session, don't worry. Okay, guys, please do not concentrate on the WhatsApp group right now. Concentrate on the lecture, and I am about to start something really, really important, which we call, what's that? Yes, according to the plan, the day one is for the audit risk. So let's start the audit risk. So please concentrate, leave everything else behind. Don't worry about the result. If you are going to attend today's lecture relevant to the audit risk, if you are going to follow the technique, I can assure you that you will be able to ace this particular topic, which is the topic number one among the major topics called audit risk. Now, let's start the show. Audit risk. Now, first of all, what's risk? Risk means there is a possibility that something unpleasant will happen. Okay, nobody likes to take the risk. Nobody is absolutely comfortable with risk. That's why auditors do not like the risk as well, and auditors are not happy about the risk either. Now the question is, what is audit risk? Audit risk is the risk that as an auditor I will express an audit opinion which is not correct under the given circumstances. So let me make it simple for you. Just imagine I was auditing a company called Company X, and at the end of the audit, I drafted an auditor's report. Within the auditor's report, there is a thing called auditor's opinion. Now just imagine my opinion is that the financial statements are expressing a true and fair view. But as a matter of fact, the financial statements are materially misstated. So if the financial statements are materially misstated, if the financial statements are not expressing a true and fair view, but you end up expressing an opinion, yes, the financial statements are expressing a true and fair view, you as an auditor are facing a risk of expressing an incorrect audit opinion. So if somebody is doing a job if somebody out there is involved in a penalty shootout when it comes to football, so that penalty shootout kicker is facing a risk of missing out the goal. So if somebody is riding a motorbike right now, he or she is facing a risk of, that he or she, God forbids, he can slip or she can slip. He or she, the rider could face an injury. So that's the risk everybody is taking right now. Similarly, when it comes to the audit profession, or when it comes to in the world of auditing, the auditors face a risk of expressing an inappropriate opinion. What do I mean by inappropriate opinion? Inappropriate opinion means that as an auditor, you would say that the financial statements are expressing a true and fair view, but as a matter of fact, they are not. Is this clear? What's audit risk? Okay. Now the burning question is why auditors all over the world face a thing called audit risk. Why? Considering the fact auditors are well qualified, well trained within the audit firms and the practice firms, well supervised, well directed, well controlled, well reviewed. Every work is reviewed. Why the auditors are still facing this huge risk called audit risk? Well, the answer to this question is auditors are facing audit risk because of two reasons. The first reason is relevant to the financial statements, and the second reason is relevant to the auditor himself or herself. The first reason behind the audit risk is called the risk of material misstatement, what we call ROMM, risk of material misstatement. Risk of material misstatement, not a misstatement, but a material misstatement, something big, something which can influence the users of the financial statements. So risk of material misstatement means that the financial statements could contain material misstatements within itself. Maybe the sales are overstated, maybe the expenses are understated, maybe the assets are overstated, maybe the liabilities are understated, maybe the disclosure is not there, or maybe the disclosure is there but it's not adequate enough. So risk of material misstatement means that the financial statements are at risk of material misstatements. Now the question is, who prepares the financial statements? Financial statements are prepared by the management. It's their responsibility. They have to prepare the financial statements. So risk of material misstatement has got to do with two reasons. The financial statements are at risk of material misstatement because of two further reasons. The first reason is called inherent risk. The second reason is called control risk. So inherent risk and control risk both leads to material misstatements within the financial statements. Now the question is, inherent risk and control risk are there, but why there is inherent risk, why there is control risk? Inherent risk has got to do with the nature of the company. Maybe it's something which is embedded within the organization. It is something within the bloodline of the organization. Maybe the accounting system is a complicated one. Maybe the employees are not well trained. Maybe the employees are not competent enough. Maybe there is an unusual pressure within the organization. Maybe the overall company is facing a decline in the industry. All those factors contribute to a thing called risk of material misstatement. But the risk of material misstatement is faced by the financial statements because of the unusual pressures, because of the things which are within the organization, and they are called inherent risk. What could be the examples of inherent risk? A complicated tax system, a complicated accounting system, employees are not they are not having the good enough motivation, or maybe their energy is on the lower side, maybe because of the unusual pressures. So all those factors are what we call inherent risk. Okay, why the financial statements are at risk of material misstatement? The second reason, or the second contributory factor of the risk of material misstatement, is control risk. Now, the control systems are designed and implemented by the management just to make sure that the chances of frauds and errors should be prevented. And if there is any fraud or error, it should be identified and resolved on a timely basis. Now, just imagine the control systems designed and implemented by the management are not good enough. They are not working appropriately. They are not good enough to counter the fraud and risk. What happens then? As a result of poor control system, there will be frauds and errors which will penetrate the system, and they will lead the financial statements, they will lead to material misstatements within the financial statements. So if the control systems are poor, that leads to a higher control risk, and a high control risk will eventually lead to material misstatements within the financial statements. So if inherent risk or control risk, or both inherent and control risk, are on the higher side, that leads to the risk of material misstatement within the financial statement. Okay, if the material misstatements in the financial statements are on the higher side, what option do I have as an auditor? I want to reduce the audit risk, right? So I've got another option. The second major component of the audit risk is an auditor specific reason, and we call it detection risk. Detection. Who has to detect? Who has to perform the detection? Detection risk is an auditor specific risk. I have to perform detection. I have to make sure that I would end up identifying the material misstatements within the financial statements. So we call it detection risk. Well, as an auditor, I might not be able to detect the material misstatements in the financial statement. And if I won't be able to detect, or if there is a risk that I won't be able to detect, this is what we call detection risk. Now, there are two components or two reasons behind detection risk. The first reason is called sampling risk, and the second reason is called non-sampling risk. So as auditors, we work on a sample basis, right? Now, just imagine if the sample which I have selected out of the entire population is not truly representing the entire population. So just imagine I selected 10% of the total invoices, and I was very happy with the results because there were no major misstatements within those 10%. But what if there were many mistakes within the next 90% of the entire population? So the sample was not truly representing the entire population. This is what we call sampling risk. The sample is not truly representing the entire population. Okay, what about non-sampling risk? Just imagine the sample was truly representing the entire population, but you did not figure out the things, or you were in a hurry, or maybe you performed wrong procedures altogether, or maybe you concluded things in a wrong way. So you cannot criticize the sample now. It's about something else, and that something else is what we call non-sampling risk. So there are two types, or there are two risks: sampling risk and non-sampling risk. Sampling risk has got to do with the sample size. You can counter the sampling risk by increasing the sample size. You cannot counter the non-sampling risk by increasing the sample size, because the problem is not about the sample. If you want to counter the non-sampling risk, you have to come up with more training, more supervision, more direction, better understanding of the things, and you have to allocate good enough time. This is how you can counter non-sampling risk. So overall, the audit risk is the risk that an auditor will express an incorrect audit opinion. An auditor's incorrect audit opinion has got to do with two things: A, the risk of material misstatements within the financial statement; B, the detection risk. So we have to make sure that if the risk of material misstatement is on the higher side, as an auditor, we have to come up with more and more detection, so that the detection risk is on the lower side, and overall the audit risk should be on a reasonable level or on a low level. Is this clear to everyone? Before I move on, I need a little confirmation from your side. Are you all clear? Okay, so Sonika is clear. Fatima is clear. Zain is clear. Saf is clear. That's great. Wakar, Hasan, Anshara, thank you very much. That's great. Okay, now it's time. Thank you, Washington. Thank you very much. Now it's time to straight away go to the exam requirement. But before I move on to the exam requirement, let me help you and let me tell you what you are supposed to do tonight. You got to read the book. You can go to the notes, or you can, ideally you should open up your book, go to the chapter called Audit Risk, read and type and learn the definition of audit risk, the components of audit risk, such as the risk of material misstatement and the detection risk. Learn the definition of risk of material misstatement and the detection risk. Then go on and type and learn the definition of inherent risk and the control risk, which are the components of the risk of material misstatement. Then go on and type and learn the definition of sampling risk and the non-sampling risk, which are further components of the detection risk. Moreover, you got to understand a little concept called materiality. Everything is not equally important for an auditor. Auditor tends to look up to things which will influence the economic decision of the users of the financial statement. So not everything is equally important for an auditor. Auditors believe on a thing called materiality. We look up to material misstatements. We don't look up to misstatements. As an auditor, if I will figure out a misstatement, I will judge it. Though it's not a good habit to judge things, but as an auditor, you have to apply your judgment, and you got to evaluate whether the misstatement is a material one or an immaterial one. If the misstatement is immaterial, I will request the management to rectify it. If they're not going to rectify it, I'll note it down somewhere in my file, but I won't argue on that because I'm looking forward for material misstatements. So as an auditor and as a student, you got to write down and type the concept of materiality and the definition of materiality tonight before moving on to the past paper questions. Now, how are we going to determine materiality? Materiality could be quantified, evaluated, or judged according to two criteria. The first and the most common one is what we called material with respect to the quantification, with respect to the weightage. And there is a mnemonic for that, and I call it RAP. R-A-P, RAP. 0.5% or more of revenue, 1% or more of assets, and 5% or more of the profit. These are the thresholds for the materiality. So if there is an expense or a liability or an asset correctly or incorrectly recognized by the client, I need to evaluate its materiality when it comes to audit risk, and the benchmark is RAP, 0.5% of revenue, 1% of assets, and 5% of the profit. If there is any item equal or over and above this benchmark of RAP, I, as an auditor, as a student, I will consider it something material. So dear students, you have to look up and you have to watch out for material misstatements. Is this clear, the concept of materiality? Can I move on to the past paper question now? No, you should not refer RAP during your exam. You should refer to the revenue, the asset. RAP is something through which I remember things. Haris, can we rely on your AA notes for learning knowledge based? Well, you can, but ideally speaking, for certain items, you need to look up to the book as well. Okay, Ali Sher has raised a beautiful question, a very well crafted question. He wants some differentiation between auditor's response and substantive procedures. There is not much difference, to be honest. Anyways, I'll figure it out. Don't worry. Okay, where do I type my questions to the tutor can see it? You are typing it and I can see it. Okay. Sir, I've got a question that there are questions in the syllabus, learning objectives, and even after reading the entire book, I am unable to figure out the answers to some of the questions. Well, you need to read the book all over again. Well, you can point me out, you can share that particular thing which you are unable to figure out from the book, and I will let you know how you have covered it. Okay, let me repeat wrap once more. 0.5% for revenue. You will figure out these wrap in my notes, which is available in the WhatsApp group. 0.5% for revenue, 1% of assets, 5% of profit. Wrap. Okay, will you practice any past paper as well during the session? Absolutely, yes. We are going to cover 2 past paper questions tonight in the today with respect to audit risk. So hang on. Okay, there is a very important question from Imran, and he's asking, what about inherent risk? Can we eliminate it? As an auditor, I can only evaluate inherent and control risk. I cannot eliminate or reduce inherent and control risk. In short, I cannot reduce the risk of material misstatement. Inherent and control risk, when amalgamated, they lead to a thing called risk of material misstatement. As an auditor, I can evaluate inherent and control risk, or in other words, I can evaluate the risk of material misstatement, and according to that evaluation, I will come up with my procedures, which is about detection risk. But I cannot reduce inherent and control risk. Inherent and control risk are client specific risk. They have to work on that. Okay, can I ask questions at the end of the webinar? Vakar, yes, you can ask the questions at the end of the webinar. Why not? Yes, Ashar, it's the profit before tax or whatever profit is available. Don't worry about it. Okay, Shali is saying I have failed the exam 3 times. So what should I do about it? I think you got to invest the next 4 hours very carefully. What do I mean by that? Once we are done with the today's session, before you join me for the day 2, you should prepare everything what I taught, especially the questions which we are going to solve tonight. You should type everything twice on the ACCA practice platform before you come for the day 2, and you should come live and exclusive on day 2. So if you really want to make sure, Shali, and if you really want to make it happen, here is the idea. Okay, when you say 5% of profit, is that profit after tax or before tax? Ideally speaking, it's profit before tax, but that does not matter. Okay, I'm having a problem with answering the knowledge-based questions. How do I approach this with the limited time available? Invest half an hour on your bookish straightforward knowledge and do not worry a lot about it. Rather than that, invest 1.5 hour or maybe 2 hours daily on your OTQs. So anyone out there, let it be Rihanna Edwards or anyone out there, you have to focus on the OTQs more and bookish knowledge based on the slightly lower side. Okay, Naila is asking, can you please share the study plan for these 2 weeks to come up with? Yes, I can share a plan. I will give you a plan, but I will give the plan on the 4th day, live and exclusive. I can't give you a plan today. I think the plan for the next 24 hours is very simple. Whatever I'm going to teach tonight, you should type and learn all that stuff bare minimum 2 times on the ACCA practice platform. That's it. Ibtisam has asked, can you repeat inherent risk? Inherent risk is something which is within the bloodline of the organization. It's not something, okay, yesterday it was not, today it is. No, it's something which has got to do with the culture of the organization, with the nature of the organization. You know, how do the people working in the organization, they think? What's their mindset? what things are considered as norm within the organization. So those things are what we call inherent risk. What is the timing for your webinar? Yeah, well, it's 5 p.m. to 8 p.m. PST, Pakistan Standard Time, plus 5 GMT. Is it necessary to cram bookish knowledge? Not really, but it will make your life a lot easier, and you just have to spend half an hour daily for the next 15 days. You can do it. More importantly, you have to work on your OTQs from both kits. Okay, can you again repeat non-sampling risk? If your sample is not truly representing your entire population, we call it sampling risk. But if your sample is truly representing the entire population, but still you are unable to detect the material misstatements within the financial statement, this is what we call non-sampling risk. Is this clear? Sampling risk and non-sampling risk. Okay. Is there any benchmarking practicing? Benchmark practicing. I didn't get the question. Okay, Eric Joseph has raised a question. I tend to panic and move across different tuition providers' notes on the last days. What would your advice on or say on this? I failed the exam 3 times on not less than 45 marks. Well, I would request you not to look up to any tuition provider, not to look up to any notes. For the last 3 days, you should have 3 past papers which are not new for you. Let me repeat, those 3 past papers should not be new for you. You should have covered those past papers earlier as well. You should type and you should learn those 3 past papers, enjoy the night, sleep well, and go on and rock the exam. Why the controls are based on business? Can you repeat control risk? Control risk means that the control system is not working appropriately, and as a result the control system is unable to prevent or detect the frauds and errors, and as a result of those frauds and errors the financial statements would become materially misstated. Is this clear? Okay. Okay, last question from Musawir is how to incorporate the ratios in the audit risk question. Well, I will guide you on that, but if that has to happen, I need to move to the past paper question now. So give me a minute. Okay. So let's start the past paper question. And before we move on to the past paper question, we need to understand the exam requirement. When it comes to audit risk, there will be one exam requirement, and that exam requirement will be tested in every sitting. So get ready. You are going to face this exam requirement on Monday, 5th September 2022. Now, what that exam requirement would be? The examiner would ask you minimum 5, maximum 8 audit risk. Describe 8 audit risk and explain the auditor's response to each risk in planning the audit. So you have to describe 8 risk, and then you have to explain how as an auditor you are going to react on that. What would be your reaction? How would you respond? So there are 2 requirements within one. A, you have to describe the audit risk. B, you have to tell me your response or your action or your plan of action. So describe 8 audit risk and explain the auditor's response to each risk, and everyone out there would face this exam requirement without any shadow of doubt. Now, what about the marking scheme? When I say describe audit risk, it means you have to identify the audit risk for the half mark from the question itself, and then you have to explain the audit risk in your own words for another half mark. That makes the overall 1 mark per described audit risk. But keep that thing in mind, if you're not going to fully explain your audit risk, you will not get 1 complete mark. So 1 mark is for 1 audit risk, provided it has got all the important ingredients. What ingredients? You have to identify the audit risk. You have to identify which risk you are talking here, because I just taught you that audit risk has got to do with 2 things. Number 1, risk of material misstatement, which has got to do with financial statements, and audit risk has got to do with detection risk, which has got to do with the auditor. So according to the examiner's report, I will read that report in a short while. Audit risk must be related to, or must be linked up to, or must have a flavor of either the risk of material misstatement within the financial statement or the detection risk. So if there is anyone out there who's going to write an answer for the audit risk without referring to risk of material misstatement or without referring to the detection risk, you have to come up with one. Obviously, you will not get marks. And then you have to explain the audit risk. You have to explain why you are skeptic. You have to explain why you think that the client's accounting treatment is not correct or could be wrong. Okay, let's continue with the marking scheme. You will get another 1 added mark for the auditor's response, how the auditor would respond to this situation. So 1 extra mark for the auditor's response, how the auditor would counter that audit risk. This is what we call auditor's response. So within the ACCA exam, 5th September 2022, you will be provided with a table. You will come up with a heading on your own. The first heading should be audit risk. The second heading, parallel to that tabular table, the second column, auditor's response. Is this clear to everyone, the marking scheme? Okay, when it comes to AA exam, as somebody just raised the question about the ratios, the audit risk could be tested in 2 possible ways. There is no third possible way. The first type of audit risk question is what we call a scenario based question only. So the examiner would explain or would let you know the background of the company, what has gone within the company, the relevant information about the company's financial year end. Okay, this happened, they purchased that, they bought this, they sold that, this was a legal claim on the company. So there will be loads and loads of company information. We call it scenario only. But there is another type of audit risk exam question where there will be a scenario plus an extract of the financial statements, not the complete financial statement, but an extract of the financial statement. We call it ratios. Now, what about ratios? Considering the fact that the examiner would give you the extract of the client's financial statements and obviously the prior year as well, we will be able to calculate certain ratios, not the complicated one, the simple one: gross profit margin and the operating profit margin, current ratio and the quick ratio, receivable collection period, payables payment period, and the inventory turnover period. So those 7 formulas would do the job nice and easy, smooth as silk. 7 formulas: gross profit margin, operating profit margin, current ratio, quick ratio, receivable collection period, payables payment period, and the inventory turnover days. Maybe gearing ratio as well. Otherwise, normally those 7 ratios would do the job nicely, easily, perfect. Okay, what's the importance of those ratios? If the examiner has provided you with certain ratios, you should ideally link up those ratios with the story or with the situation of the company within the scenario. So you should explain your audit risk by integrating the ratios and the scenario. Well, we will cover questions according to both type 1 and type 2. The beautiful thing about the audit risk is the exam requirement in both cases would remain same. If the examiner has provided you with the financial statement extract, or if the examiner has not provided you with the financial statement extract, in both the cases, the exam requirement would remain same, which is great. Now we are about to move to the past paper question, but before we move on to that, we need to understand how are we going to explain the audit risk. And we all know the audit risk could be classified into two categories. The first category is called risk of material misstatement. So if we have to describe audit risk, to be precise, risk of material misstatement, how are we going to do that? First of all, which financial statement items are at risk of material misstatement? So a good answer would highlight which financial statement item is at risk. For example, assets are at risk of overstatement, or maybe liabilities are at risk of understatement. So you should highlight which financial statement item are you talking about. Ideally speaking, you should highlight which financial statement items. Sometimes it's the dual effect. So maybe the client has incorrectly capitalized a certain amount as an intangible asset. What does that mean? That means the intangible assets are overstated and the associated expense which should have been charged by the client, the expenses are understated. Or if you are not sure whether the client has correctly classified intangible asset or not, I will say there is a risk that the intangible assets are at risk of overstatement and expenses are at risk of understatement. So you got to understand what I'm trying to tell you here. Sometimes the client's accounting treatment would be wrong, and sometimes the client's accounting treatment would be open-ended. You're not dead sure about it. So you have to choose your words carefully. If you're dead sure that the client's accounting treatment is wrong, you would say non-current assets or intangible assets, whatever it is, are overstated. If you're not sure, you will say there is a risk that the tangible assets or the intangible assets are at risk of overstatement. So the first item which you need to clear or you need to mention in your answer is which financial statement items are at risk of material misstatement. Then you should explain why you think as an auditor that the client's accounting treatment is wrong if you're dead sure about it, or the client's accounting treatment could be wrong if you're not dead sure about it. If you're dead sure about it, be aggressive. Say it's wrong. Say it is not in line with XYZ accounting standard. If you're not dead sure about it, be someone having skeptic attitude. Express your doubts. There is a risk. So you have to explain there is a risk that the intangible assets are maybe incorrectly classified. So you have to be skeptic. You have to create doubts in your mind. Last, please note that if the client's accounting treatment is wrong, you're not supposed to say there is a risk. You are supposed to say this is not correct. This is wrong. So you have to use your words carefully according to the situation of the question. Okay, the second component of the audit risk is called detection risk. Detection risk is the auditor specific risk. Detection risk means auditor might not be able to detect the material misstatements in the financial statement because this is a new audit client which we are dealing. So considering it's a new audit client, we will lack the accumulated knowledge and experience of that particular client. Maybe the industry itself is altogether new for us. So we might not be confident when it comes to the opening balances because those opening balances were not audited by my audit firm. Time pressure could create detection risk for the auditor. Because of the time pressure or because of the lack of resources, I might not be able to deliver the job. Because of the detection risk, because of the issue with respect to competence, I might not be able to detect the material misstatements. Last but not the least, I would like to add another example. This is very important, especially for today's class. If your client is utilizing the services of a particular third party, let's say they have outsourced their receivable collection department to a third party. Maybe they have outsourced their payroll department to a third party. That creates a detection risk for the audit firm, because the completeness and accuracy of the payroll or the completeness and accuracy of the receivable would be at stake. You might not be able to gather sufficient appropriate audit evidence in relation to that particular amount, because there is an involvement of that third party. You never know with that. So this is what we called audit risk. Normally 99%, in the 99% cases, the examiner would test this risk of material misstatement, but you never know, examiner could test detection risk as well. Okay, now last thing before we finally move to the past paper question, how are we going to explain the auditor's response? Auditor's response means how are you going to react against the risk? Well, if there is a risk, I need to counter that. How I'm going to counter that? I will come up with a plan, and my plan is my auditor's response. So an auditor's response could be a procedure as well. Somebody was asking me this earlier. It could be a procedure, or it could be a plan for the procedure, plan of action. The response must be a response of the auditor. Think like the auditor, don't think like the client. And your response should be directly related to or relevant to the risk. So as an auditor, with the help of the response, I need to either contradict or counter the risk, or I need to confirm the risk. So I need to confirm what's going on. What I'm thinking negatively, are things really that negative? So I need to come up with certain action, and that action is what we call auditor's response. Is this clear? This is it. I am done with the first topic. Now I need to go to the past paper question. And before I move on to the past paper question, yes, we have to think and act like an external auditor, Anshara, absolutely. Okay, Jamil Shehzad has asked a question. Can I copy fully the risk from the question? Yes, you can copy the risk from the question, but if that has to happen on your final exam day, you need to practice on the ACCA's practice platform. Yes, this lecture is recorded and it will be available. Yes, I can repeat the ratios. Why not? Gross profit margin, operating profit margin, current ratio and the quick ratio, receivable collection period in days, payable payment period in days, and the inventory turnover period. The normal ratios, nothing special about it. Okay, now it's time to start the questions. And what questions do I have for you? Well, for tonight's session, I've got 2 questions on audit risk. One of the question is probably from March, June 2021. And the second question is from March, June 2022. So these are extremely latest past paper questions. Probably you will be able to figure out both of these questions on the ACCA's practice platform. Okay, let's start the show. And why I've selected 2 questions, why not 1, why not 3? Because the first question which I've selected for you, this is a very long question, but this has got no extract of the financial statements. And the second question which I've selected for you, obviously it's in a separate sheet. That second question is from Yeah, this question is from March June 2022. So this is the most latest AA past paper question available to anyone out there on this planet Earth. So we have got two most recent past paper questions. Let's start the show, and let's start from the first question, which is called, the question is called heart. Okay, what about the exam requirement? Part A, explain the benefits of audit planning. What kind of question is that? What kind of question is that? Can you answer this? Explain the benefits of audit planning. Thank you very much. This is a straightforward bookish knowledge based question. There are two options for me tonight. There are three options. Option number one, I should not study anything at all, and I should feel confident after attending the webinar. The webinar was great. The tutor made things easy. I should not study anything. Option number two, I should prepare the audit risk question. I should type it twice, learn it twice on the ACCA practice platform. That's option number two. I might be able to pass, but I can fail it as well. Now, what about the third option? The third option is, do not only concentrate on the main audit risk requirement, rather give due importance and respect to the bookish knowledge based question as well. Why not? So you should invest quality time on this part A. What about this part A? Explain the benefits of audit planning. Well, if we are going to plan the audit, we will be able to figure out the problematic areas in advance. We will be able to allocate the most suitable, the most experienced staff to the critical areas of the audit. If we are going to plan the audit, we will be able to make sure we do not run out of time. We will be able to make sure that we will be able to collect sufficient appropriate audit evidence, which eventually leads to lower audit risk. We will be able to make sure, if we follow the plan, that this whole audit should be a profitable activity for the audit firm. We should not, overrun the cost itself. So in the solution, obviously, you will be able, part A is a straightforward knowledge question. So it's up to you. Straightforward knowledge question. Is this clear? What are the benefits of audit planning? It will help the auditor to devote appropriate attention to the important areas. We will be able to identify and resolve potential problems on a timely basis. We will be able to make sure that we finish off the audit effectively and efficiently without prolonging it without any reason. We will be able to involve the expert where required, because we'll plan it in advance. So this is it. That was the part A. We are done with part A. Explain the benefits of audit planning. This is a straightforward bookish knowledge, so it's up to you now. Part B, describe 8 audit risk. 8 audit risk means 16 marks, because the identification and explanation of 8 audit risk will give us 8 marks, and the auditor's response would give us another 8 marks. That makes 16 marks. Okay. What about part C? Describe substantive procedures. Oh, substantive procedures. Substantive procedures are the agenda for the day 3. So I promise that on the day 3, I will come back to this very question called heart, and we will figure out the part C on the day 3. Is this clear? Can we skip the part C for now, for the next 48 hours or so? We'll come back to it, don't worry. Part D, explain the safeguards which the audit firm should implement. That's the name of your audit firm. How come I know that? It is 1st July 20x5. This is important. What's today's date? 1st July 20x5. And you are what? Audit supervisor with an audit firm called Moff and Company. So what safeguards the audit firm needs to implement in order to ensure that this conflict of interest is appropriately managed. This is an official terminology when it comes to the profession of auditing. This is what we call conflict of interest. Now, what's conflict of interest to be precise? Conflict of interest is a situation. This is from chapter number 4 of the book and chapter number 5 of my notes. Anyways, conflict of interest is a situation where one audit firm is auditing a company, let's say called KFC, and the competitor of KFC, such as McDonald's, would approach the very same audit firm for the sake of audit. So if I am considering the audit of McDonald's, although I'm also auditing Kentucky Fried Chicken, this is a situation called conflict of interest. Well, by law or according to ACCA, you're not disallowed, or it's not prohibited to not to execute audit of both KFC and McDonald's at the same time. Okay, you are allowed to do that, but you've got to understand that this is a very, very tricky situation. You might breach the fundamental principle of ACCA's code of ethics and conduct called objectivity. You might be biased in favor of one against the other. You might breach the fundamental principle called confidentiality. You might reveal, the secret recipe of KFC to the McDonald's or the vice versa. So if a professional firm is auditing or considering auditing two companies which are the competitors or which are involved in trade with each other heavily, this whole situation is an official situation and we call it conflict of interest. Now, considering it's not illegal to execute the audit of both KFC and McDonald's at the same time, the audit firm would need to manage. The audit firm needs to come up with certain actions. The audit firm has to do something. What can they do? They need to ensure they protect objectivity and they protect confidentiality. What they're supposed to do then? Well, they can do many little things, such as what? First of all, they need to make sure that they have obtained the consent from both clients. Why McDonald's and why KFC is going to provide you the consent? Because you are going to come up with certain other actions as well, such as you are also going to advise both clients to get legal advice if they want to. You will use separate engagement teams, definitely with separate engagement partners, just to make sure there is no overlapping. You will make sure there is a strict physical separation of both teams. Maybe you will execute the audit from different cities, from different offices. You will provide clear guidelines to each and every member of the audit team. You will make sure that both the teams will sign a confidentiality agreement. You will make sure that the judgments are critically reviewed by someone who is not involved in the audit of both KFC and McDonald's. Last but not the least, overall regular monitoring of the controls should be there. So this is, what kind of question is that? What kind of question is that? Anyone, please help me out. Yes, Asnan, you are absolutely right. Yes, SN. Yes, Shivani, you are absolutely right. This is what we call bookish, straightforward knowledge-based question. So there will be 3 types of students during the exam. One who will say, yeah, I know that, but I can't write it. I'll do it later. I know that. Second, those who are going to say, what's that? I don't know about it. And the third one, they will score 5 out of 4. So just imagine if this is your final exam and you are already done with what? You have done nothing so far and you have already scored 5 marks over here, 4 marks over here, and that gives you 9 marks. Is this clear? Have you scored 9 marks? You are still left with 60 mark paper when it comes to section B, and you have already scored 9 marks. Just imagine you have already scored 24 out of 30 in OTQs. So you are already somewhere around 34, 33 out of just 40 mark paper you have attempted. So you just need 16 marks, 15, 16 marks out of 60 marks to pass the exam. So this is the beauty of section A OTQs. If you are going to score 24 in section A, and if you are going to score good marks in the straightforward bookish knowledge questions, you will have a winning day on 5th September 2022. Now I'm left with the last requirement, which is describe describe 8 audit risks and explain the auditor's response to each risk in planning the audit of hard company. So this is the main event. This is the real thing. This is what we are here for. Before I move on to this main event, I would like to have a break for 5 to 10 minutes, because after the break, I need to come up with 2 questions. Number one, this whole question called hard, and this from March, June 2022, this latest question, and this has got ratios as well. So let's have a break for max 10 minutes. We'll resume at 6:30 p.m. Right now it's 6:20 p.m. So I'll resume after 10 minutes. So don't go anywhere, because these 2 questions could convert your ordinary day to a successful day on Monday, 5th September 2022. Hang on. Let's have a break. अस्सलाम वालेकुम, कैसी हैं आप? ठीक है? Okay, then now it's time to start and resume rather, and we have to solve and we have to go through two questions relevant to the audit risk. Let's move on. We have already covered the rest of the exam requirements except for this part B. We have to describe 8 audit risk. Most probably the examiner would have provided you with 9 or maybe 10, or sometimes if he is generous enough he can come up with 11. So more than 8 would definitely be there. That's a sure short thing. Okay, let's start reading the question from the scratch. So it is 1st July 20x5 and you are an audit supervisor with an audit firm called MOF Company, and you are responsible for planning the final audit of a new client, Heart Company, for the year ending 30th September 20x5. So the year end is on 30th September. So July, August, September. So 3 months are still there, but you have started working on the client because you need to start early because this is the new client. And normally we do start early. We tend to work on the controls. We need to work on the risk assessment, the planning stage. So this is 1st July, 3 months before the year end. And we are working on a new client called Heart Company. Did I teach you that new client is one of the example of an audit risk? To be precise, which audit risk? Option number 1, risk of material misstatement. Option number 2, detection risk. Which risk? Yes, thank you very much. It's about the detection risk. Thank you very much. Now, let me show you something from the examiner's report. Oh, give me a second. Well, I'll show you later. I was referring to something where the examiner would say that always refer your answer to either, maybe it's here. Yeah. Give me a second. Okay. Part B asks for audit risk and responses, right? This requirement is sitting, this requirement is examined every sitting. You must make sure the risk relates to either what? Option number 1, risk of material misstatement or a detection risk. So considering this is a new audit client, what is that? Option number 1, risk of material misstatement. Option number 2, detection risk. What's that? Definitely it's about the new audit client, and this has got to do with the detection risk. So you will copy that from the question. You're not supposed to write new audit client. No, simply start Heart Company is a new audit client for MOF Company. The team will lack the accumulated knowledge and experience. They might not be familiar with the accounting policies, transactions. There will be an added doubt over the opening balances because the audit was not performed last year by the MOF Company. So how are we going to respond to that? How are we going to tackle this situation? Well, we need to allocate the most experienced and suitably trained team. We need to allocate good enough time or adequate time in order to audit, in order to make sure that audit team members are able to understand the company, so that they could reduce the risk of material misstatements not being able to be detected. And we need to increase procedures over the opening balances as well. So this is the first risk which we have identified from the question, and this is the response. There are typical words. Audit team is not familiar with the increased detection risk, less assurance over opening balances, suitably experienced team, adequate time should be allowed to understand for the understanding of the company, increased audit procedures should be performed over the opening balances. So these are the key words you need to learn and you need to utilize in your answer. So are we clear? Can I have confirmation on that? Are we clear with the first risk? Yes, we can. We can increase substantive testing, more particularly towards the opening balances. Okay, so are we clear? Okay, great. That's great. Let's continue with the question. So Hart Company specializes in the design and construction of customized playgrounds. The audit manager recently met with the Hart Company's finance director and has provided you with the following notes. Okay, let's start the notes. So they had a meeting and here are the notes. Hart Company has a forecast profit before tax of 12.2 million. I can ignore that. And total assets are expected to be 28.5. I can move on. The finance director has indicated that the directors are very, very happy. They are very pleased with the forecast performance for the year, as the directors are paid a bonus based on a percentage of profit before tax. Okay, now imagine yourself as the directors of a company called Hart Company, and I am the auditor. You guys are the directors. Your bonus is dependent upon the company's profit before tax. What would you do? You will try to maximize the company's profit before tax so that your bonus could be maximized. In order to maximize your bonus, you might add material misstatements within the financial statements in order to boost the profit before tax. You might overstate the revenue, you might understate the expenses, just to make sure that the year end profit before tax is on the higher side, just to make sure the bonus itself is on the higher side. Is this clear? So that creates an overall risk of material misstatements within the financial statement, because the directors might try to overstate the profit. They might try to overstate the profit by increasing the revenue or by understating the expenses, because they want to maximize the year-end profit, therefore leading to a maximum bonus. Let's check it out. The directors are paid a bonus based on the percentage of profit before tax for the year. So this is something which you'll copy from the question. Don't come up with the heading directors bonus. There is a risk the directors will try to overstate the profit, and therefore their bonuses, they will try to overstate the profit so that their bonus could be maximized by increasing the revenue and income and by decreasing the expenses, especially when it comes to judgmental areas such as provisions. Now, what should we do? How the auditor is going to respond? I think first of all, the audit team needs to be aware of the risk of manipulation. They need to allocate good enough time in order to understand the company, specifically the risk of overstatement of profit. Last but not the least, they need to maintain professional skepticism and they need to be alert with respect to the increased risk of manipulation. You're not supposed to write everything. You need to blend it up and you need to come up with one solid answer, maybe 2 sentences, that's it. So let me highlight the key words for you. So they might try to overstate the profit. How? By increasing the revenue. How? By decreasing the expenses. The audit team should be aware of the risk of manipulation. They need to allocate more experienced audit members, and they need to, understand the company, and they need to remain alert, and they need to apply professional skepticism. Is this clear? Are we clear with the second risk? Can I have confirmation on that? Are we clear? No, Fatima Zora, your answer should not be that detailed and that lengthy. That answer which is available in the past paper, is an ideal answer. It covers every aspect of it. If somebody is going to produce the 50% of it, he or she will score 1 complete mark. You have to come up with one idea for 1 mark. So it's not about reproducing everything, it's about extracting something out of it which makes sense. No, Zulkarnain, either you are not supposed to refer auditing standards, forget it. Yes, you are supposed to refer accounting standard where required, and that's a very limited list of accounting standard. IS 2 inventory, IS 10 events after reporting period, IS 16 property plant equipment, IS 36 impairment, 37 provision, 38 intangible assets. That's it. Okay, Asher has asked, should we explain that 1 point or just write to the point? Well, I would encourage you to blend 2 points and come up with your own notes and with your own answer. Okay, I will share the list of those standards in the WhatsApp group. Don't worry. Is this clear? Tehreem Fatma, right now there is no azan going on. Well, I will give you a short 5-minute break. Don't worry, everyone out there. I'll give you another 5-minute break. Hold on. Let's finish this question, and before the next question with the ratios, we'll have a 5-minute break. Okay. So as of now, we are done with 2 risks. The first risk was relevant to the new client. The first risk was relevant to the new client. Here it is. That was the first audit risk. The second risk is directors are paid bonus based on the company's profit before tax. So we are done with 2. We need 8. Let's move on. Each company is undertaking the construction of playgrounds at 16 sites in various locations across the country. Good for them. All playgrounds are constructed to specific customer specifications. Customers pay a 25% deposit on signing the contract, with the balance payable when the control of the playground is finally transferred to the customer. Okay. Considering the directors want to maximize the profit before tax, they might recognize the revenue relevant to those 16 sites too early. They might recognize the revenue although the contract is not finished as yet. They have not transferred the control of the playground to the end user, to the customer, but still they want to recognize the whole revenue. So the revenue at the year end could be overstated. And what about that 25%? That 25% should not be recognized as a revenue. Rather, that 25% should be recognized as a current liability because it's a prepayment. So the year-end revenue could be overstated. The prepayments could be understated. Why? Because the directors could have wrongly classified the advance payment as a revenue, although it should not have been recognized. So there is a risk that revenue could be overstated. I'm not sure what the client has actually performed. So this 25% deposit on signing the contract, that's the third risk we have. What should be the response? I think I need to review the contract between the customers and the company in order to understand the nature of the agreement, in order to understand what can be recognized and what cannot be recognized, and at what point of time it should be recognized. I need to have a discussion with the management regarding the accounting treatment of that 25%. I need to make sure they have recognized it as a prepayment. If they have recognized as a revenue, I need to request them to write it off from the revenue. Okay, let's see what the question has to say, what the solution has to offer. So customer pays a 25% deposit on signing the contract to purchase the playground. So this is something from the question itself. That deposit should not be recognized as revenue immediately, and instead should be recognized as a deferred income, contract liabilities within the current liabilities until the performance obligations are satisfied. So we can skip one paragraph. There is a risk that revenue is overstated. That's the key word. And the current liabilities are understated if the deposits have been recorded within the revenue. I'm not sure what they have performed. So that's why I'm saying if the deposits have been recorded within the revenue. I'm not sure. What about the response? First of all, the audit team needs to understand the nature of the agreement between the customers and the company, and for that they need to review the copy of the contract. Secondly, they need to discuss with the management the criteria for determining whether the performance obligation have been satisfied or not. We need to understand that they correctly recognize the revenue within the correct accounting period. So we need to make sure during the final audit that at the year end we need to perform extraordinary testing over the cut off of revenue, because they need to recognize the revenue in the correct period, not too early, not too late. So this is it. That was the third audit risk. After new client, directors are paid a bonus. Now the 25% on signing. The balance of work in progress at 30th June 20x5 is 7.6 million in respect of the playgrounds under construction. Okay, this amount seems to be material. A work in progress count and valuation will be carried out at all 16 sites on 30th September. Okay, work in progress and stock take will be on 30th September. Arrangements have been made for the audit team to attend only 5 of the work in progress counts. So the audit team will be able to attend only 5 counts. So the audit team will not be able to attend 5 counts. Oh, that's sad, because there is a possibility that there would be certain material balances on the sites where the audit team would not be able to attend. So the audit team will only attend the work in progress counts for 16 sites. Work in progress is a material balance, and the valuation of work in progress is a judgmental area. The audit team is not attending all those sites. As a result, the auditor might not be able to detect the material misstatements. So that increases what? Detection risk. So this is the second example of detection risk from this solid past paper question. Detection risk, how? Because the audit team is not able to attend the all sites, all 16 sites. As a result, there is a possibility that the auditor might not be able to gather sufficient appropriate audit evidence. What should be the auditor's response? Well, it's not practically possible to attend all 16 counts, but the auditor should identify the problematic sites having significant or material balances, sites which are famous for their poor controls, so that the audit team should attend those sites, because those are extremely important sites. Is this clear? The auditor should assess which inventory count teams will attend, most likely to be those with most material balances. So I need to attend those with most material balances, which are assessed as having the greatest risk of misstatement. So that was another risk, that the audit team will only be able to attend 5 sites. Okay, another sentence. The warranty provision for the current year has been calculated as 2% of revenue. In the previous year, the warranty was 6% of revenue. So 2% of revenue. Last year, it was 6% of revenue. Why is that? The finance director has made this change despite no significant difference in construction techniques or the level of claims in the year. Then why the hell finance director has reduced the warranty claim percentage, warranty provision from 6% to 2%? Because they want to understate the liabilities, because they want to understate the expenses, because they want to come up with better picture. So there is a risk that the warranty provisions at the year end are understated. Why? Because each company offers its customer a warranty at no extra cost, which guarantees the playgrounds will function as expected for 3 years. The provision is calculated as 2% of revenue in the current year against 6% in the prior year. Despite it, all this is from the question itself. Now, under IS 37 provisions, contingent liabilities and contingent assets, this should be recognized as a warranty provision. This should be. Why the answer is so aggressive? Because according to the question, there is no major change in the work methodology. According to the question, the level of claims are already there, 6%. Then why would you change it? So they should recognize this as a warranty provision. Calculating warranty provision requires judgment, as it is an uncertain amount. So there is, you can skip this sentence. You can skip this sentence and you can straight away go, there is a risk that warranty provision could be understated, leading to understated expenses and liabilities. What would be your response? First of all, you need to have discussion with the management, and you need to understand why they have, changed the criteria from 6% to 2%. Moreover, the audit team needs to compare the actual level of claims with the year-end provisions just to make sure that their assumptions are reasonable. Is this clear? So that was about warranty provision, and this was another audit risk. How many risks we have identified so far? New audit client, directors are getting bonuses based upon the company's profit, 25% advance could be recognized as a revenue, which should not be the case. Number 4, work in progress is a material item and the audit team cannot attend all of them. 5th, the client, or for that matter the finance director, has reduced the warranty provision from 5% to 2%. Let's move on. Each company has incurred expenditure of 1.8 million relating to the research and development of a new type of environmentally friendly building material. 0.6 million of the expenditure to date has been written off to the profit or loss account. The remaining 1.2 has been capitalized as an intangible asset. No amortization has been recognized to date as the material has not been brought into use. Okay, fine. What's the risk over here? Well, IAS 38 intangible asset has a very strict criteria with respect to the capitalization of intangible asset. The criteria is also known as sector criteria. So what if this 1.2 million does not meet the criteria? What if the year-end intangible assets are overstated and the associated expenses are understated? So considering they have recognized 1.2 million, you never know, this does not meet the criteria. What should be the response? I need to obtain the supporting documents of the 1.2 million. I need to understand how the management truly believes that this 1.2 million does meet the criteria as we speak. We need to understand their assumptions, and we need to understand their assumptions are appropriate. So let's check it out from the solution. All that is copied from the question. You can copy all that from the question. IAS 38 intangible asset has a strict criteria. There is a risk that the requirements or the criteria is not fully applied, and as a result there is a risk that the intangible assets could be overstated and the research expense could be understated. What should be your response? The audit team, first of all, they need to get the breakdown of the research and expenditure. They need to look for the supporting documents. They need to understand and they need to discuss with the management that the accounting treatment has been appropriately followed in accordance with IAS 38. So this was the 6th audit risk relevant to the research and development expenditure. We'll have a break at 7 p.m. Hold on for the next 5 minutes. In June 20x5, the company contracted to purchase new machinery costing 2.4 million. Okay. They paid 1 million on signing the contract to secure the machinery, which was due to be delivered within the accounting year, that is first within the July. Due to a supplier problem, the delivery is delayed and is now scheduled to be delivered in October. So it's about new machinery, certain plant, certain machinery, I-16 property plant equipment. So they paid 1 million in advance. That should be recognized as a current asset prepayment. You cannot recognize that amount as a non-current asset. So in the response, I need to make sure by reviewing the non-current asset register, they should not recognize that 1 million as a non-current asset. What's the risk over here? Which financial statement item is at risk? Can you tell me which financial statement item is at risk? Yes, tangible non-current assets are at risk of overstatement. Only assets which physically exist at the year end should be capitalized. So if you have paid 1 million as an advance, that should be recognized as a prepayment. Is this clear? And what should be the response? You need to review the non-current asset register and make sure they have not capitalized it as a non-current asset because they have not received the asset at the year end. So that was the 7th audit risk. Okay. In order to finance the research and development cost and the machinery purchase, so they need money for the R&D and they need money for the machine. The company made a right issue to existing shareholders at a price of 0.75 for each 0.50 share. Whenever the company raises money, there are two options: A, from the shares, B, from the loan capital. Now this question is about the first option, which is about the shares. So as an auditor, you will always look up to the split of the share capital and the share premium. We all know that the nominal value credits or nominal value goes into the share capital, and the premium goes into the share premium account. So the client has raised certain amount with the help of right issues. There is a risk that they have not correctly classified the whole sum into the share capital and the share premium account. So this is the eighth risk, I guess, from this question. The right issue has been made at a premium and therefore requires to be split into share capital and share premium elements. Now there is a risk that the issue has not been correctly classified into share capital and share premium. What should be the auditor's response? First of all, you need to obtain the legal documents relevant to this share issue, just to make sure that you truly understand the nature of the agreement, and then you can and you should recalculate the split of the share capital and share premium and reconcile or agree with the journal entry to make sure there is no misstatement. So that was, I guess, the 8th audit risk. We are about to finish off this question. So far we have identified 8. Let's read the next sentence. Each company's payroll function is outsourced to an external service organization. Oh, well, which is responsible for all elements of payroll processing and maintenance of payroll records. So this is another example of detection risk. This is the third detection risk in this question. The first one was new audit client. The second detection risk was the audit team is unable to visit all 16 sites on the stock count day, and as a result the audit team will only visit 5 sites out of the 16. You never know, among those 11 sites there could be material misstatement which the auditor might not be able to detect. So that was the second detection risk. The third and the final detection risk, I believe, is the client is utilizing an external service organization for the payroll function, and that creates a problem. And the problem is that the detection risk is increased because you might not be able to obtain sufficient appropriate audit evidence in relation to what? The completeness and accuracy of controls over the payroll cycle, and as a result the liabilities at the year end. So this is a very important sentence which I would highly recommend you to learn it. This could be in case of receivable as well. The client has outsourced their receivable collection department. This could be the case. As a result, I would transform the sentence: each company's receivable collection department has been outsourced to an external service organization. A detection risk arises as to whether sufficient appropriate audit evidence is available with the client to confirm the completeness and the valuation or the accuracy of controls over the debt collection and the receivables at the year end. So you could maneuver it. Is this clear? Now what should be the response? First of all, you need to consider, are you going to contact the auditor of the service organization? If yes, you may look for the type 1 or the type 2 report, and you need to consider whether you will be able to obtain sufficient appropriate audit evidence or not. If you're wondering what's type 1 or type 2 report, type 1 report is a report which I, as an auditor of my client, will ask from the auditor of that service organization, and I will ask, what controls do you have in place? That report is called type 1 report. And if I will ask how effective those controls are, that's what we call type 2 report. Obviously type 2 is more comprehensive than type 1. So now we have identified 9 audit risks. Now the last paragraph of the question, and we are done with the 2021 past paper question. Each company's directors correctly disclose their remuneration details in the forecast financial statements in line with IFRS standards. Good for them, very good. However, local legislation in the country in which each company is based requires more extensive disclosure. Okay, they should follow that as well. Always remember, local legislations are far more important. The directors have stated that they consider this onerous and so do not intend to provide the additional information. If they are not going to provide the additional information, this would be considered as a material misstatement because an important disclosure according to the local laws would be missing. So the director's remuneration disclosure will not be complete if this additional information is not available. Is this clear? So they have to comply with local laws and regulations, and if they are not going to do it, their financial statements would be considered as materially misstated. What should be the response? We will discuss this issue with the management, and we'll review the local laws as well, and we'll request them to incorporate this disclosure within the financial statements appropriately. Now I'm done. Let's count how many risk we have identified. So new client was the first risk. Directors are paid bonus, that creates the risk of material misstatement manipulation, second. 25% deposit could be recognized as a revenue, which should not be the case, that was third. 5 sites could be visited out of 16, that's a detection risk, that's number 4. 2% of revenue, 6% of revenue to 2% of revenue warranty provision, so that was your 1 2 3 4 5. Research and development expenditure was 6. New machinery, they have not received it, 7. Share price, share premium and share capital, 8. Outsourced to a service organization, detection risk, 9. Local laws disclosure, 10. Are you clear with respect to these 10 risks? Can I expect you to type and learn these 10 audit risks, all 10, on the ACCA practice platform? Will you type it twice? Will you learn it twice? And even you can save that particular file and share it with your tutor from the ACCA practice platform. You can extract that file and you can share that file with your tutor. Thank you very much. I appreciate that if you could do it. Okay, now before we move on to the break, or before we move on to yet another past paper question on audit risk, and trust me on that, with the help of those 2 questions, one hard and one from the latest 2022 paper, you will rock the audit risk big time. In fact, you should teach someone audit risk, well, not tonight, after 3-4 days, once you are done with the webinars. Okay, now it's time to answer a few questions. There are many, so I need a bit of a time. Okay, Eric Joseph is saying, guide us on using ACCA solution on past exam. Some have said that we should not replicate the answer. Well, you cannot replicate them 100%, but you need to extract 50-60% out of it. Okay, wait. Yes, Sept, there is a risk the directors might have understated the expenses or overstated the revenue because they want to maximize the profit, leading to higher bonuses. Okay, when will it be uploaded on the channel? It takes about at least 24 hours. So it will be available, but after 24 hours. So I would highly encourage you to attend those sessions live. Sometimes it takes more than 24 hours. Okay, Shivani has asked, you are saying don't come up with the heading. That means, yes, you should not write director's bonus, work in progress valuation. Don't come up with headings. Okay, sir, what about standards? I've already answered this question. Can we give brief explanation of risk or explain proper? Brief explanation of risk. Yeah, you should come up with brief explanation of the risk. Does ACCA give point marks for response to a risk if not fully? Yes, Rihanna Edwards, if your response is not a good response or not a well drafted or crafted response, the marking scheme, the marker would give 0.5 mark rather than 1. Jameel has raised, or Jameel has, explained things beautifully. So we have to write short but adequate to save time and get marks. Absolutely, yes, without any shadow of doubt. So Musafir is saying that somebody suggested him to give headings. There are no marks available in the marking scheme for headings. So what's the point of giving headings? In fact, Musafir, let me help you with that. Once we are done with the webinars, I will share a very, 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 very important article with you on the WhatsApp group, maybe after 2-3 days after the webinar. That article has got real past paper answer from a real student, not by any examiner. And those answers has been marked by the ACCA marking team. And you will realize there are full marks awarded to the student and there are no headings over there. So, well, Musafir, last thing, if headings has got any marks, why not marking scheme is referring to it? Simple as that. Okay, Naila is saying, please also share the ACCA platform link to the WhatsApp group. Naila, come on, you have to Google it, right? ACCA practice platform, AA. You'll figure it out. Otherwise, I'll share a video how to access the practice platform, how to make the best use of the practice platform. In fact, somebody out there will share the video because somebody out there will have that video. So somebody out there who is listening to me, share that video, but not right now, at the end of the webinar, like after an hour or so. In fact, after 2 hours or so that people could join in. So after 2 hours, somebody will share that video, how to access the web, how to access the ACCA practice platform. Okay, Anshara, don't worry. I will share the link with you. Don't worry. Once I'm free, don't worry. If the some, okay, thank you. Don't distract me, please. Okay, so who needs a 3-4 minute break, right? Before I move on to the March-June 2022 paper, which is the most recent paper I've got, or it's on the planet Earth. So do you need a break or should I move on straight away? Okay, this is a break for max 5 minutes. It's 7:11 p.m. right now. Let's come back after 5 minutes. Don't go anywhere because this is the most recent paper and you will realize the real exam difficulty according to that question. Thank you. See you soon. 5 minutes. Okay, guys, it's time to finish off tonight's day one of the AA Practice to Pass webinar by ACCA on a high note. And we can finish this off on a high note by, making sure we are comfortable with the latest past paper question, which is from March-June 2022. Straight away, let's check out the exam requirements first. Part A, describe the preconditions for an audit that B company should have established prior to accepting the audit of E company. Now the preconditions are three, and all those three preconditions are actually a straightforward bookish knowledge based question. There are three preconditions for an audit. Now if somebody is wondering what's that, first of all, dear students, you got to go through the chapter number 4 called Ethics and Acceptance. The chapter Ethics and Acceptance has got two major topics in it. A, ethics, B, acceptance. When it comes to ethics, there are 5 fundamental principles called ICOP square: integrity, confidentiality, objectivity, professional competence, and due care. Last, professional behavior. Then there are 5 threats: advocacy threat, self-interest, self-review, intimidation, familiarity. So 5 fundamental principles, ICOP square, 5 threats to objectivity, ICOP ASSIF. Once you are done with the first topic called ethics and acceptance, which I will cover on day 4, the second part of the chapter number 4 from the book is acceptance. You're not supposed to accept any XYZ client. So there is a process called which client should be accepted and which client should be rejected. And that whole process is called factors to be considered when accepting a new audit client. And those factors are called triple P, triple R, IMMF. So you got to check out the chapter number 4, and the topic is called acceptance consideration, triple P, triple R, IMMF. You will figure it out in the notes, chapter number 5 as well. So don't worry. Within that mnemonic of triple P, triple R, IMMF, there is one important P called preconditions. Now, what do I mean by preconditions? Preconditions means if these 3 things are not established by the client, as an auditor, I cannot execute the audit. Now, what are those 3 mighty things which, if not established by the client, the auditor will not execute the audit? Number 1, the financial statements in accordance with the applicable financial reporting framework should be prepared by the management. Second, the management should design and implement a control system which will facilitate the preparation of the financial statement. So they should come up with a control system as well. Last but not the least, the client should agree that they will acknowledge their responsibility and they will provide with all the necessary information which is required, and they will cooperate. So these 3 things are called preconditions for an audit. As a student, you got to go to your chapter number 4 of the book, or the chapter number 5 of my notes, I guess it's called acceptance consideration, and you got to prepare the whole triple P, triple R, IMMF. Not only one P, but all of the ingredients of that. So this is a straightforward bookish knowledge question, part A. Majority student will not attempt it, minority will attempt it, and only, the very rare students would be able to score 4 out of 4. So what about part B? Using the table below, calculate the following 4 ratios. 4 ratios, but for both years. That means 0.5 mark for one ratio for 1 year. 1 ratio for both year will give you 1 mark. So this is about 4 marks, and these are very easy marks, and note formulas are not required to be shown. So it's a very common question across the world from the AA students. Do I need to write the formula? No, you are not. you're not supposed to write the formula. So earlier on, Musawwir was asking, do I need to write the headings? No, you should not write the headings. So what about the 4 formulas? Which 4 formulas? Well, you can calculate gross profit margin. You can calculate gross profit margin. You can calculate inventory turnover days. You can calculate trade payable days, and you can calculate the receivable payment period. This is it. You just need 4. That's it. Part C, using the information provided and the ratios calculated, describe 8 audit risks, a big question, comprehensive question, and the auditor's response to each risk in planning the audit of e-company. Part B is about substantive procedures the auditor should perform to obtain sufficient and appropriate audit evidence in relation to the company's trade receivable. We will come back to this part D on the day 3 once we have covered the substantive procedures. So as of now, we are done with part A. As of now, we have to skip the part D for 6 marks. And as of now, I assume you can calculate the ratios very quickly. I'm giving you 2 minutes for that, and then we'll explore the part C from the scenario itself. So I'm giving you 2 minutes maximum to calculate the ratios. Do it. Remember, this is the last year, and this is the upcoming year. Calculate the ratios, please. You have got 2 minutes to do that. Okay. So assuming you have calculated the trade receivable collection period, that's an important one. Assuming you have calculated the trade payables payment period, because the trade payables have gone up by a huge margin. Even the inventory itself as of valuation has gone up by a huge margin, and quite unusual as compared to other questions. The trade receivables have gone down. Okay, so I think it's time to start the question. It is 1st July 20x5, and you are an audit supervisor with an audit firm called B & Company, and you are responsible for planning the audit of a new client. Okay, new client. What does that mean? New client, what does that mean? Yes, absolutely. This creates detection risk. Now, dear students, please realize something. If you have practiced, typed, and learned that question called hard, would you be able to score 2 out of 2 over here? Is there an element of repetition in AA exam? Is this a monotonous exam? If you are going to prepare 4 to 5 questions on audit risk twice on that thing called ACCA practice platform, would you be able to attempt the final mock exam with great energy and with greater marks? Would you be able to ace your mock exam? Eventually, would you be able to clear your final exam on 5th September? It is what it is. You have to understand there is a huge element of repetition when it comes to AA. So if somebody out there who is going to attempt this final exam and who did it know the detection risk is a new client is a detection risk, but he's not or she's not well prepared for that, I do not even feel sorry for him. You have to work harder tonight on these 2 questions, and that will help you in passing your mock exam, in passing your final exam. Okay, let's continue. So this is a new client and the year end is 31st August. You are an audit manager, your audit manager recently met with the finance director and has provided you with the following planning meeting notes and the financial statement extract. Okay, let's read it. E company is a manufacturer and wholesaler of plumbing supplies. It operates from 2 warehouses which are situated in the north and south of the country. Extract from the forecast financial statements. Okay, fine, nothing special, move on. So what's the year end? I forgot. What's the year end? Okay, 31st August is the year end. In September 20x4, that is during the year, the company purchased a patent for 2.6 million, which gives it the exclusive right to manufacture a waste disposal system for a 4-year period. The purchase cost capitalized comprise the cost of the patent and other costs such as legal fee and administrative costs incurred in negotiating the contract. Is there anything which is not correct? So they purchased a patent for 2.6 million, and that amount incorporates the legal fee along with the administrative cost. Now that administrative cost should not be recognized as an asset. So this is about the new client. Let's ignore that because we have already covered this new client thing. We already know there will be doubts over the opening balances, less assurance over the opening balances. The company will not be familiar. So we need to move a suitably experienced team. We all know the wording, right? E company purchased a patent in the year and has capitalized all the costs within the intangible assets. There is a risk that the costs such as administrative costs incurred in negotiating the contract have also been capitalized, which is not in line with IAS 38 intangible assets. So the intangible assets would be overstated and the expenses would be understated. So the intangible assets would be overstated or the profit would be overstated as well. What should be the response? The audit team should obtain the breakdown of the amount capitalized. Dear students, please tell me, is this story familiar to you? Are you familiar with the glimpse of it? IAS 38, intangible asset, breakdown of the research and development. IAS 38 has a strict criteria. The intangible assets could be overstated. Are you having the glimpse of it from the previous question? Yes or no? Yes, Ibrahim Khan, you are absolutely right. Admin cost should be expensed out. But what I'm trying to ask, is this a completely new story for you, or are you having some kind of familiarity with this particular story from the previous question? Is this monotonous? Is this repetitive? Yes? Surely yes from Zarar, absolutely yes. So it's kind of repetitive. So if somebody is well prepared for that, I doubt that he or she cannot score 1.5 out of 2, maybe 2 out of 2. But bare minimum 1.5 if the student is well prepared for that one. Yes, Mustafir Hussain, you're absolutely right, because it's about IAS 38. Even the response is very much similar to the last one. So far, we have identified 2 audit risks in this question. So far, we have identified 2 risks and both are repetitive for us. Let's continue. In order to finance this purchase, in the last question, the company issued shares, if you remember. Now let's read this one. In order to finance this purchase, the company obtained an interest-bearing loan of $2.5 million during the year. Good for them. The bank loan is payable in 5 equal annual installments, with the first installment due to be paid after the year end, that is on 1st September 20x5. What's the audit risk here? Which financial statement item? There is a risk that the client has not correctly classified the current liability and the non-current liability in accordance with the loan agreement. So I think even this third audit risk about the 2.5 million, I believe it's a repetitive, because it's not about the share capital and share premium, but it's about the current liability and the non-current liability. The response would be more or less same. In that response, you were looking forward to review the share issue agreement, right? Now you have to look for the loan agreement and try to understand the nature of the agreement, try to understand what part of the liability should be classified as a current liability and which part should be classified as a non-current liability. Moreover, you should look for the finance cost as well. So we have identified third risk from the most recent past paper question, and all three are repetitive, at least as far as I can see them. Yes, I understand you might say, or you might feel, oh well, it's easy for Sir Ahmed, not for me. Well, it would become easier for you, mark my words, once you have typed, learned, invested bloody 2 hours on that question using the ACCA practice platform, and then come back to this question. So this is it. We are done with 3 questions now. Let's go to the 4th risk. Let's figure out the 4th risk from the question itself. But before we move on to the 4th risk, let's see what the solution has to offer regarding this. So yes, they borrowed 2.4 million. Yes, there is a risk that the current liability and the non-current liability is not, allocated correctly. Yes, the audit team needs to recalculate the split. Yes, they need to understand the local laws and they need to review the disclosures, all that stuff. The audit team could also recalculate the finance cost just to make sure there is no mistake in the finance cost. Is this clear? So how many risks we have identified so far? 1 relevant to the current non-current liability, 1 relevant to the IAS 38 intangible assets, 3rd relevant to the new client. Yes, 3 down, 5 to go. The payable ledger clerk has recently discovered a batch of supplier invoices that had been miscoded and therefore had not been recorded as trade payable. Oh, that leads to understated trade payables. This error has now been corrected, but investigations are still ongoing to determine how this happened and whether any other batches of invoices have been miscoded. Well, there is a risk that there are other batches which have been miscoded, maybe intentionally or otherwise, and as a result, the year-end trade payables could be understated, the expenses could be understated as well. So read this story. A batch of invoice was miscoded. Investigations are still ongoing. All that has been copied from the question. Moreover, the payable payment period has decreased from 64 to 39. This suggests that there are other payables which have been miscoded as well, and there is a huge risk that at the year end purchases and trade payables could be understated. The response: the audit team need to come up with detailed testing on trade payable balances. Especially, they should perform supplier statement reconciliation in order to make sure that the year-end liabilities are correctly recorded. Just read this one. Moreover, you need to have a discussion with the management, try to understand what procedure they have adopted in order to rectify the mistake, in order to identify other mistakes. So now we are done with another thing, which was about miscoded supplier invoices being miscoded. So that was the 4th risk. Let's continue. E-company sales staff receive bonuses if they meet sale targets each quarter. A higher level of sale bonus is available in the quarter to 31st August each year as a reward for efforts during the year as a whole. So did we encounter this situation where the director's bonus were aligned with the profit before tax? Now that's a bit different, but that's not completely different. Now the sales staff's bonus is aligned with the year-end sales. So they might come up with manipulation. They might want to recognize those revenues which should not have been recognized. So this is the same old story. There's nothing new in it. So I believe this sales staff receiving bonus is a repetitive one. Is this the case? Do you agree with me that this is some kind of a repetitive for us? So Musawwir Hussain and Naila Akhtar do agree with that. Laiba, if they have miscoded it, they have not actually recognized it as a purchases as a payable. So they have not recognized that as a payable. So that understate the payables. Maybe they have miscoded other payables as well, thereby leading to understated payables. Is this clear to you, Laiba? Okay, so this is a repetitive one. Now we are down with what? 5. Okay. Okay, let's continue. E-company offers its regular customer discounts of up to 10%, which are negotiated and documented by the sales director. Okay, fine, no problem with that. This year, in order to easily monitor the amount of the customer discounts, they have been recorded separately as an expense in the cost of sale. In previous years, revenue has been recorded net of the discount. This is not correct. If they are not going to recognize the revenue net of the discount, this leads to overstatement of revenue. Remember, dear students, those trade discounts are not recognized as a revenue. The company needs to recognize the revenue after adjusting for those trade discounts. So this leads to overstatement of revenue. Now, this is something new. I agree. I agree that this is something new, and this is something unusual. Trade discounts offered to regular customers have been separately accounted for as an expense. Trade discounts should be offset against the revenue. So there is a risk that revenue and cost of sales are overstated. Revenue is overstated, so as the cost of sales. So audit team need to discuss with the management the rationale for doing it. They need to request them that in accordance with IFRS 15 revenue, they need to adjust the discount, and then they need to recognize the revenue. Okay, so that was the sixth risk, right? Customer discounts. That was the sixth risk. Okay, I missed one paragraph. There was a fire in the South warehouse in June 2005, which resulted in damaged inventory. An inventory count immediately following the fire identified that inventory costing 1.1 million required to be fully written off. The damaged inventory has not yet been replaced as there is sufficient inventory in the North warehouse. The directors have raised a claim against the e-company's insurance company to cover the full extent of the lost inventory. Although no confirmation has been received from the insurance company, the directors are confident that the amount claimed of 1.1 million will be received and have included this amount as a receivable within the current assets. So this whole lengthy paragraph has got two risks. One, they need to write off the inventory. There is a risk they have not written off the inventory, and as a result, the inventory could be overstated, the expenses could be understated. Second, according to IS 37, you can only recognize the contingent asset if it is virtually certain. Considering no confirmation has been received from the insurance company, this should not be recognized as a current asset. Rather, if it is probable that they will eventually receive the income, only then they can disclose it as a contingent asset. So as of now, their current assets are overstated with respect to receivable as well. So now we have identified two more deficiencies over here, and those two deficiencies are relevant to inventory of 1.1 million, which should have been charged to the profit or loss account. Moreover, the inventory days have gone up from 117 to 135. There is a risk that damaged inventory has not been written off, and it is there within the closing inventory. Inventory may be overstated. Second risk, the IS 37 provision contingent asset. As the insurance company has not responded, this should not be recognized as a contingent asset. Is this clear? Now we are done with many risks. How many risks we have identified so far? Okay, let's count. The first one was about new client. Second was about the intangible assets being overstated. The third one was about the loan, the split of the loan. The fourth one was about trade payables being understated because of the miscoding. That was fourth. The fifth one was about inventory being not written off. The sixth one was receivables could be overstated. Sixth. The seventh one was sales staff receiving bonuses. The eighth one was the discounts were not net off, rather they were identified separately, thereby leading to overstated revenue. So we have already identified 8 audit risks. Still we have got 2-3 paragraphs. We might be able to identify 9th or 10th one. The manager in e-company's credit control department has been off work since December due to ill health and has been replaced by an inexperienced temporary manager. As a result, e-company has not been monitoring aging of its receivable and only follows up on outstanding balances when the system alerts the credit controller that a customer invoice has been outstanding for 90 days or more. The standard credit terms are 30 days. So the year-end receivables could be overstated. Why? Because there is no credit control department. The person is ill. They are not monitoring it. So this clearly is an easy risk with respect to year-end receivables. Let's read it from the solution. E-company's credit control manager has been off work and has been replaced by an inexperienced manager. All this from the question. The receivable collection period has gone up significantly from 65 to 85. This indicates that they are unable to collect their debts, and as a result, there is a huge risk that the year-end receivables could be overstated and the allowance for the doubtful debt, or specifically the bad debts, could be understated. What should be the response? I think you need to extend the post year-end cash receipt testing. You need to identify whether those receivables have now been converted into cash or not. So you need to extend the post year-end, yes, after the year-end cash receipt testing, in order to verify whether those receivables have now been converted into cash or not. So that was the 9th risk from the question. Last paragraph, there is a tax investigation going on against the company. The directors do not intend to record anything, although they should record 0.6 provision, but the directors do not intend to record anything. They should recognize provision against the, they have to pay certain compensation or fines to the tax authorities. So this is the last risk we have got. The company is under tax investigation. There would be a penalty of 0.6 million. Therefore, a provision should have been recognized. There is a risk that provisions are understated and the disclosures are inadequate. So this is it. I'm done with 10 audit risk. We only had to come up with 8, but we have identified more than, out of those 10 audit risks we have just identified, I believe at least 6 were repetitive. Even this provision one is a repetitive one. So if you have got any questions or any concerns relevant to the audit risk, you are more than welcome. What about tomorrow? Well, I'll be starting internal control systems tomorrow, which is the major topic number 2. So what advice do I have for you? Well, my advice is solve 3 OTQs in the morning and 3 OTQs in the evening. Maybe in the morning use BPP kit, in the evening use the Kaplan kit. Solve OTQs from both kits. That's short thing, without any shadow of doubt. You cannot skip them. Eric has raised a question. Can you write more audit risks to maximize your chances? Well, if the examiner has asked you for 8 risks, attempt the 8 best risks you know. Skip 9th and 10th. Skip the one you are not comfortable with. Once you are done with the full exam, and if nobody is interested in talking to you, check. Maybe the person sitting next to you is interested in a bit of a chit chat. Maybe you can exchange your numbers. But if nobody is interested in you, sorry, mate, then you can add the 9th and the 10th audit risk. Otherwise, I would never recommend to write more than the required. Okay. Okay, that was unintentional. So my advice is stick to the marking scheme and stick to the, the number of requirements which the examiner is asking for you. What about substantive procedure? Well, I will discuss substantive procedures on day 3. But if the examiner has asked you for 6 procedures and you know 7, or if you're good at 8, write the best 6 and then move on to the next question. Once you are done with the full exam, yes, if you want to add cherry on the cake, go on. Okay, though cherries are very expensive. So now, Rihanna Edwards, you are my favorite now because you have raised a very important point, and that is, so what is the task for the today? My dear, tomorrow I will start internal controls from the scratch at 5 p.m. my local time. Before that, you have got almost 21 hours. Within those 21 hours, I want you to type and learn all the parts of the questions we did today. Heart, and what was the name of this question? Well, the name of this question would be definitely ESC company, because this is the name of the client. So whatever the name of this question is, Heart and ESC from 21 and from 2022, you got to type each and every part except for the substantive procedures. Yes, you can ignore substantive procedure. So if you're going to leave substantive procedure, it means out of 30 you will be leaving a 5-mark part and a 6-mark part. Roughly speaking, you need to type and learn the 50-mark paper relevant to audit risk at least twice on the ACCA practice platform. Moreover, you should learn and type the definition of audit risk, risk of material misstatement, detection risk, inherent risk, control risk, sampling risk, non-sampling risk, materiality, what's material by nature. There are certain things which are important irrespective of their amount, such as the director's remuneration, such as the compliance with the laws and regulations, performance materiality. So this is something which you should cover within the next 24 hours. But top of the line priority should be these 2 questions from the recent past paper using ACCA practice platform. Is this clear? Are we done? And yes, I will add you in the WhatsApp group. Don't worry about it. I need some time. Definitely, I'm going to have a bit of a break and then I will start sharing the link. Don't worry. You rock, Laiba. You rock. That's great. Keep it up. Thank you, Shivani. Yes, S company. Ibrahim Khan, how to tackle the bookish knowledge question? A, focus on OTQs, not on the bookish knowledge based questions. B, whenever you are typing and preparing and learning a new question, a question from the exam kit or from the past paper, do not ignore the part A, the part D, which are straightforward bookish, such as we had a discussion today regarding the benefits of audit planning, such as we had a discussion today regarding the preconditions for audit, such as we had a discussion today regarding the how to manage the conflict of interest. So don't ignore them. Simple as that. Umar, which mnemonic? I guess you are referring to the mnemonic from the chapter number 4 of the book called Triple P, Triple R, I, Double M, F. You will be able to figure out that mnemonic from the chapter called Acceptance from my notes. Don't worry. Thank you very much, Haris, and you're most welcome. Thank you, Anshara. Thank you. Ibtisam, I can break a lot more jokes. You can bet on it. So thank you very much for all the appreciation and good words. Thank you very much. This session is a complete waste if you will come up tomorrow without working harder on these 2 questions. But if you do it, trust me, you will enjoy tomorrow's session more than today, because you will all of a sudden you will start believing that you can make it on the 5th September. We are not supposed to attempt the exam on Monday 5th September. We have to secure it. Thank you very much, Musafir and Amir. Sir, how I can join? Well, you have to take, oh well, last but surely not the least, last but surely not the least, this is my number right now in front of you. You have to text me up and I'll send you the link for the WhatsApp group. Thank you very much. I'll see you tomorrow after 27 hours, exactly after 27 hours. and I really hope so, and I'm really praying. I wish you all the good health. I wish you all the peace at your home or at your workplace, because I really want you to type and learn those 2 questions within the next 24 hours using the ACCA's practice platform. Nothing more, nothing less. Thank you very much. Bye bye. Well, I will share the important accounting standard list in the WhatsApp group. Bhumika, is this clear? Rihanna Edward is saying, what is the estimated time to complete one question? Take your time, invest 2 or 3 hours on one question, no worries. But when I say 3 hours or 4 hours on one question, I mean prepare it, invest your time, learn the responses, learn the keywords. As a result, there will be a thing called, from the PM paper, from the quantitative analysis, called learning curve. So you will become familiar with the task and you will get quicker, you will become smarter, and you will shine. Everything is available within the description of the WhatsApp group. Thank you. Okay, thank you very much. Which link is not working, Muiz? Okay, Fatma, I'll share the PPP kit in the WhatsApp group as well. Which link is not working, Muiz, to be precise? Oh, well, WhatsApp. Which WhatsApp group link or the description link? You have, Muiz, you have to text me up and I will add you in the WhatsApp group, or I'll share the link. Don't worry. Yes, Muiz, you have to text me up. The number is on your screen right now. You have to text me up on WhatsApp. Thank you very much. I'll see you soon.